Hello everyone, welcome to the 159th episode of me learning how to trade in Forex. So in the last episode, we were carrying on from where you left off at the find the right product lesson, and then we continued going through the the assets we could invest in. So it went through, can't even remember where we went through. I think we started off with the exchange traded funds, and then we went through the exchange traded commodities, trading and leveraged products, contract for differences or CFDs, did this little question, spread betting, options, and two different types of options. So we've got vanilla options and barrier options. And then we went through the spot market or the spot trading, and then finally went through the futures. So yeah, and now I think we're on the exchange traded products. So yep, exchange traded products. So let's get started then. Exchange traded products. Exchange traded products. Exchange traded products. So there's a wide range of exchange traded products available to trade depending on where you reside. While exchange traded ETCs and ETFs. What? Where does ETCs come from? Oh, exchange traded funds and exchange traded commodities. I forgot what they were standing for. So while exchange traded funds and exchange traded commodities also falls into this category, they're often used as part of the long-term investments. Some exchange traded products, like the ones we're about to discuss, are more sophisticated than others and can be better suited to traders, not investors. This is because they're designed to help you seize opportunities in the short-term moves in an underlying asset. These products give you exposure to a range of assets including shares, indices, forex, commodities, and even cryptocurrencies. Let's see how they work and what makes them different to over-the-counter trading products like CFDs. Exchange traded funds and exchange traded contracts. Commodities. Commodities, exchange traded commodities. Also fall into this category. They're often used as part of the long-term investments. However, they're often used as part of long-term investments. Some exchange traded products, like the ones we're about to discuss, are more sophisticated than others and can be better suited to traders, not investors. This is because they're designed to help you seize opportunities in the short-term moves and in underlying assets. These products can give you exposure to a range of assets including shares, indices, forex, commodities, and even cryptocurrencies. Let's see how they work and what makes them different to over-the-counter trading products like CFDs. Turbo warrants. Homework. Your success in using both trading and investing products will depend on how well you understand the correlation between the shares you own in your long-term portfolio and those you prefer to trade instead. Understand the correlation between the shares you own in the long term and those you prefer to trade. Play around with this tool, share dealing versus turbo SPOC, to see how different asset classes correlate to one another. If you ran this experiment with your favorite share and currency pair, do you understand how the one would affect the other? You need to understand the correlation between the shares you own in the long term in your long-term portfolio and those you prefer to trade instead. Research how different assets correlate with each other. So turbo warrants. underlying asset price, time. Notional trade value £100. Knockout level £90. Turbo 24 price, your outlay £10. Funded by issuer £90. Turbo warrants or turbos are leveraged securities. Turbo warrants. Turbo warrants are leveraged securities. You can use them to go long or short on a market, and their price tracks the underlying asset 1-for-1. So you can go long or short as their asset price, as their price tracks the underlying market price 1-for-1. For each turbo trade, you select the knockoff level that controls your maximum risk. Oh wait, I forgot. Cheeky little diagram. Okay. For each turbo trade, you select the knockoff level that controls your maximum risk. So, for each turbo trade, you select a knockoff level that controls your maximum risk. You select the knockoff level that controls your maximum. This level indicates the level. Wait. This level indicates the point where you'll exit the trade if the market moves against you. So this is like a stop loss level. Your initial outlay also acts as your maximum possible loss. Wait, so for each turbo trade, you select the knockout level that controls your maximum risk. Knockout level here. So this would be your stop loss. This level indicates where you exit the trade if the market moves against you. This level indicates the point where you'll exit the trade if the market moves against you. Your initial outlay also acts as your maximum possible loss. Your initial outlay, so this is what you put in, right? This is the initial outlay. No, wait, your initial outlay is £10. Oh wait, so is this your margin and this is the leverage? So you put in £10 whilst your issuer funds you £90. So this is like a leverage. Yeah, a leverage securities. Right, okay, so this is your margin. The £10 is your margin. The £90 is your leverage. Right, okay, so your initial outlay, so initial deposit acts as your maximum possible loss. There are two types of turbo warrants, long and short. Two types of turbo warrants, long and short. You buy long turbo if you expect the underlying market price to rise, and if it does, you make a profit. You buy long turbo if you expect an underlying market's price to rise. If you expect an underlying market's price to rise. And if it does, you make a profit. And if it does, you make a profit. Short turbos are best suited for when you expect the price of the underlying asset to fall. If it does, the short turbo's price will rise in value. So this is like, well, basically the same as going long and going short, isn't it? So you buy short turbo if you expect an underlying market's price to fall, and if it does, you make a profit. You make a profit. Short turbos, oh no, if it does, the short turbo's price will rise in value. What is that? Short turbo price will rise in value. So then you can sell it on. No, wait, you can't sell it on higher. What? Short turbos when you expect to fall. So you do expect the value of it to go down. If it does, the short turbo's price will rise in value. I thought it's like a normal short trade where you buy it at a lower price. Oh no, you buy it at a high price, you sell it at a high price, and you buy back a lower price. So sell it at a high price, and then buy it back at a lower price. But this one's saying the turbo's short price will rise in value. If it does, the short turbo's price will rise in value. These instruments include leverage, but the amount you take on is based on where you set your knockout level. As leverage is included, the amount you take on, so the amount your position is that, I think that's what I'm trying to say, is based on where you set your knockout level, which is your stop loss. The closer it is to the current underlying assets price, the higher the leverage. The closer the knockout level is to the current underlying asset price, the higher the leverage. Closer it is to the current underlying asset price, the higher the leverage. Shouldn't be the closer it is to the current, the lower the leverage, because, oh no, this is assuming that the underlying asset price is really far away, or the price is really high compared to what you put in, right? The closer it is to the current underlying asset price, the higher the leverage. So the more the what's it called, issuer has to fund you. There can also be a great tool for traders looking for a leverage trading product with downside protection. So that was turbo warrants. Covered warrants. These leverage products, again, covered warrants are leveraged products. So these leverage, let me just do this. No, that can be Word. Covered warrants. these leverage products give you the right but not the obligation to buy or sell underlying asset at your chosen price sometime in the future. Covered warrants give you the right but not the obligation to buy or sell an underlying asset at your chosen price sometime in the future. They're similar to options because you pay a premium. You pay a premium. The difference is that your risk is limited to that initial outlay, limited to your initial deposit. Your risk is limited to your initial deposit. If you like to take a long position, you buy the underlying market with a call warrants. So if going long, you buy the underlying market with a call warrant. In this instance, you think that the market price might rise beyond your strike price. If it does, you can exercise your right to buy the underlying asset for less than the current market price. You think that the market price might rise beyond your, what do they call strike price, your chosen price. If going long, you think that the market price might rise beyond your chosen price. So you buy the underlying market for call warrants. If the market price rises beyond your chosen price, you can exercise your right to buy the underlying asset for less than the current market price, If you're planning to sell the underlying asset instead, if going short, essentially taking a short position. If you're planning to sell the underlying instead, you use a put warrant, essentially taking a short position. Here you can make a prediction on falling markets and try to make a profit by selling the underlying for more than the current market price. Right, so if going short, you think that the market price might fall above, right? I won't say above, fall above your chosen price. So you sell the underlying market with a put warrant. If the market price falls above your chosen price, basically, say you want to sell something at £10, right? Oh wait, so no, you do a put warrant for £10 2 years into the future. Okay, 2 years into the future has come. The underlying market, oh no, the market price is, you can sell it for £8. Okay, so that means you can then exercise your right to sell it at more than the current market price. Sell the underlying asset for more than the current market price. You make a profit there. If that makes sense. You can exercise your right to sell the underlying asset for more than the current market price. Let's try a working example. Say you've been monitoring the share price for ABC PLC, which is currently £110 per share. You think that it will rise in the next 4 weeks, so you decide to purchase a call warrant for £10, which for a strike price of £100. So strike price, remember, is your chosen price. So you think it will rise in the next 4 weeks. So purchase a call warrant for £10, and you think that in 4 weeks' time, you have the right but not the obligation to buy the share price at £100. Okay. Price outlay, so this is your margin, this is your you put in £10, so this is your margin. Well, let me just keep reading through actually. If you were right and the share price increased to £150, you can exercise your right to buy it and make a profit of £40 because you're trading with a leveraged derivative. You don't need to own the share itself to make money. Had you been wrong and the share price of ABC PLC dropped to £50, you only lose your initial outlay of £10 because of the built-in risk protection of this product. So you can only lose what you put in. The maximum loss is your initial outlay. The combination of limited risk and leverage mean that you're able to increase your exposure to the underlying market and magnify potential profit while preventing amplified losses. The combination of limited risk and leverage mean that you're able to increase your exposure to the underlying market and magnify potential profit while preventing amplified losses. Constant leverage certificates. A constant leverage certificate, CLC, is another ETP, exchange traded product, that helps traders limit their risk. These products can give you exposure to assets like shares, commodities, or Forex. While they're designed for traders, you can also be used by long-term investors with low levels of leverage. This is because when you purchase a constant leverage certificate, you can decide on the leverage that suits your risk profile. When you purchase a constant leverage certificate, you can decide on the leverage that suits your risk profile. They also have no expiry dates, but if you hold them for longer than a day, their performance can start to differ from that of the underlying. They have constant leverage certificates has no expiry date, but if you hold them for longer than a day, the performance can start to differ from that of the underlying. This is because the leverage compounds at the end of the day. But if you hold them for longer than a day, their performance can start to differ from that of the underlying asset. This is because the leverage compounds at the end of the day. So this is because the leverage compounds at the end of the day. Your potential profits will be amplified, but so will any losses. These are calculated by multiplying the underlying's daily performance with the leverage factor you select. Right. Like covered warrants, these products limit your risk so that you never lose more money than you initially put in. Constant leverage certificate limits your risk by so that you never lose more money than you put in. Let's look at a working example. Say you decide to go long on ABC PLC and buy X5 CLC for £20. So 5 times constant leverage certificates. So buy five constant leverage certificates for £20. The leverage allows you to take a position worth £100. If the underlying price increased by 20% and closes at 120 at the end of the day, your profit will be £20, 100% return. Yep, because 120 minus 100, 20, and you only put in £20. If the underlying market gained another 20 with the same 5 certificate the next day, it will close at £144. Your profit would now be £44. So 20% of 120 is, 120 plus 20% is £144. Your profit would now be 44 because your initial position is worth £100 and it's risen to 144. So 144 minus 100, that's 44. The compounding effect that we've seen here will continue for as long as your position remains open. This means that at the start of each trading day, your leverage level times 5 will be applied to the new value of your total position. However, the same compounding applies to any losses. After day 1, if the underlying price has dropped by 20%, it will close at £80. The market moved past your initial outlay, so it would be knocked out of the trade. £100 minus 80, that's 20, and you only put in 20, so boom, you're out. Remember, both your profit and losses will also be affected, so you may need to monitor any long-term positions. Yep, remember, both your profit and losses will be affected, so you may need to monitor any long-term positions. Choosing the right product combination. As you can see, there are lots of different products that will help you access the financial markets. We've covered in our previous lessons how you can use your risk profile and time horizon to help you choose which ones are right for you. You might also consider leverage and how well you understand each product to aid in your decision making. Remember though, you can have multiple financial goals you want to achieve. Therefore, you could follow a multi-product strategy which we'll cover in the final lesson. Remember that you could follow a multi-product strategy, which we'll cover in the final lesson. Cool. So lesson summary: buying shares using managed portfolios or investing in exchange-traded funds and exchange-traded commodities fall under long-term investment activities. They don't include any leverage and can be considered low risk. Short-term trading can be divided into over-the-counter and other exchange-traded products. Both might be considered high risk and have their own distinct benefits. Over-the-counter products like spread bets and CFDs, contract for differences, enable you to trade on spot markets, options or futures. Exchange-traded products like turbos, constant leverage certificates and covered warrants help you limit your risk so that you never lose more money than your initial outlay. Spread bets, CFDs, turbos, certificates, no, not certificate, what's it called? Constant leverage certificates. Constant leverage certificates are covered warrants that are all considered to be leveraged derivatives. So you never take delivery of the underlying asset. So you never own the underlying asset, basically. Yeah, do I need to write? Have I got this? I'm buying shares using managed portfolios or investing in ETF for under long-term investment. So, long-term investment activities. Buying shares using managed portfolios, investing in exchange traded funds and exchange traded commodities fall under long-term investment activities. They don't include any leverage and can be considered low risk. They don't include any leverage and can be considered low risk. Short-term trading. Short-term trading activities can be divided into over-the-counters and other exchange-traded products. Divided into over-the-counter and other exchange-traded products. Both might be considered high risk and have their own distinct benefits. Both can be considered high risk and can have their own distinct benefits. So over-the-counter products like spread bets and CFDs enable you to trade on spot markets, options or futures, like spread bets and contract for differences enable you to trade on spot markets, options or futures. Exchange traded products like turbos, constant leverage certificates and covered warrants help you limit your risk so that you never lose more than your initial outlay. So exchange traded products like turbos, constant leverage certificates and covered warrants help you limit your risk. So that you never lose more than your initial outlay. So that you never lose more than your initial deposit. Spread bets, CFDs, turbos, constant leverage certificates, uncovered warrants are all considered to be leveraged derivatives. Spread bets, contract for differences, turbos, constant leverage certificates and covered warrants are all considered to be leveraged derivatives. Are all leveraged derivatives. So you never take delivery of the underlying asset. Okay, so have I missed anything out on here? I don't think I have, to be honest. Got that diagram, got that spread betting. Have I got this diagram? I do not. Where's spread betting? So spread betting. Contract for differences. Yep, contract for differences. We've got exchange traded funds, and then we've got managed portfolios, and then we've got share dealing. So I think we got everything we need. Options, vanilla options, barrier options, spot futures, exchange traded products, turbo warrants, right here, covered warrants, constant leverage certificates. Let's just copy this one in, might as well. Constant leverage certificates. Constant leverage certificates. Okay. Cool. Choosing the right product combination. Gone through that. Yeah. Using a multi-product strategy. Multi-product strategy. Let's see, using multi-product, what day is it today? 0706. So, one of the beauties of the stock market is that you can engage it with however you choose. As we mentioned previously, you may prefer to use different products simultaneously to help you meet your financial goals. In this lesson, we'll outline some of the common multi-product strategies used by traders and investors. You can select elements from one or more of the methods we've included, or create one that's tailored to your needs. However, before we jump into some examples, let's look at why you might want to use a multi-product strategy, which we will do in the next video. So yeah, I've got some nice diagrams, some nice 3D pyramids, so looking all very good. Alright, I'm going to leave this episode here then, so thank you all for watching. We've finally managed to go through find the right product, going through all of the assets we can trade, invest or trade in. So that's really good. And yeah, so in the next video, we're going to go through using a multi-product strategy. So see you guys then. Peace.